Let's take a look at Chapter 12 called Corporate Valuation and Financial Planning. And the things we talk about mostly in this chapter is what they call the additional funds needed equation and a little bit about forecasting and some tools that we can use to kind of forecast what our results will look like in year 2, 3, 4, just some period in the future. And so here's that same kind of slide we look at with every chapter and kind of what we're at here. So now we're forecasting operations. So that could be forecasting free cash flows. And to forecast free cash flows, I have to look at my projected income statements, what my projected financing will look like, and a projected balance sheet. So it's really about projecting all of our financial statements and then producing cash flows from those. And of course, we have to make assumptions whenever you do forecasting, and they talk here about what policy assumptions are, and we'll get into what that means as we go through the chapter. And so every company does forecasting. I've been a part of many organizations. We did this every company I was at. And you basically do a main forecast, but you also kind of look at variations of that, saying, okay, what if this happens, then what? So a lot of companies will do various forecasts based on different things they think may or may not happen down the road. But the point of doing this is trying to determine what the intrinsic stock price will be and to determine if the company grows, will extra financing be needed to support the growth? Okay, so that's one of the biggest topics of the class. And so the example they're giving us is a company called Hatfield, and they've got their balance sheet right here. You can see what this is, both sides balance, probably in the millions, so $6,390,000 on both sides. And we also have their income statement. You can see that they were profitable, $297 million on $9 million worth, $297,000 based on $9 million worth of revenues or operating costs and so on. Then over here, what they paid for dividends, the addition to retained earnings. Hopefully you kind of see that the net income of $297 would make retained earnings go up, but then we paid dividends of $100, so the net increase is $197. 50,000 common shares, earnings per share, dividends per share, and the stock price was 41. And just some ratios for Hatfield versus the industry. The blue is Hatfield, the black is the industry. You can see kind of what those are right here. And some are better than industry, some are not as good, kind of a mixed bag with them, but they're doing okay, I think it's fair to say. And so as we compare between the Hatfield and the industry, they have a lower operating profit, they have a worse capital requirement ratio, and a lower return on invested capital. And their ROIC is less than its 10% WACC, which is never good. You want your ROIC to be above your WACC. So they're not as good as those of their competition. Is not adding value to its investors. So overall, they're kind of negative. I mean, there are some bright spots in here too, but overall, they're not very good. Okay, so with that then, let's do a few more ratios. So they're comparing leverage and risk. Remember that leverage means really how much debt do you have. So debt to total asset ratio shows more leverage, and then the total liability to total asset ratio also shows more leverage than the industry. And the combination of higher interest payments and lower operating profitability causes their times interest earn ratio to be lower than the industry average. And so we're going to kind of use the DuPont equation. So remember, this goes back a few chapters. I believe it was chapter 4. We looked at ratios and the DuPont equation. And remember, the DuPont equation is made up of 3 categories. M, meaning margin, is net income divided by sales. TAT is total asset turnover, sales over total assets. Equity multiplier is total asset divided by equity. And so the combination of the 3 categories multiplied by each other gives you your ROE. So they're going to give us the ROE of Hatfield is 10. The ROE of the industry is much higher at 15. So obviously we're not doing that great. So profitability ratios, and it's nice to, what I should point out is, what's nice when you use the DuPont equation I can see one for one, how do I stack up with each of the three categories, right? So my profitability is much lower. My total asset turnover is a little bit lower. My equity multiplier, though, is better. So I've got one of the three is better than the industry, but the other two are lower, and my profitability one is really low compared to industry. So that's kind of hurting the overall number that I get. Okay, so that just kind of helps you figure that out. Okay, so that leads us to what they call the AFN, the Additional Funds Needed equation. And it basically just says, if the company grows, how much financing will be needed to support the new growth? Okay, so think of it as being a manufacturer or even a retailer, and just, if I grow by a certain percent, that means I need to buy more product or open new stores or buy more machinery, make new product, whatever that would be. A certain amount of growth will require extra financing. So we're trying to figure out what new assets do we need to acquire to support the growth, and then also keeping in mind that as the business grows, you kind of get a new level of what they call spontaneous assets and liabilities. And we're going to focus first on spontaneous liabilities, meaning accounts payable and accruals, right? So if I launch a new product line and I buy a bunch of machinery to build a new product or make a new product, that means I have to buy raw materials. Well, I'm going to finance a lot of that raw materials through accounts payable. I'll call up my regular suppliers and say, we're going to take on this new initiative. I need to buy more inventory, and they'll most likely say, sure, we'll ship it to you. And here's the terms, 30 days or whatever it would be. And also think about accruals, if you can remember back to accounting principles and accruals and accrued revenues, accrued expenses, accrued liabilities, all those things. And just as the business grows, accruals grow. If the business shrinks, accruals shrink. They kind of come along for the ride. And then we also subtract reinvested profit, basically net income left over after dividends are paid. Okay, so we need to acquire new assets. Some of that acquisition will be financed with spontaneous liabilities. Some of that acquisition will be financed with reinvested profits. Okay, that's kind of how we take a look at that. Okay, so some assumptions for the example we'll look at is we are currently at full capacity. So that means if we're going to increase sales by 10%, we have to increase capacity by 10%. Otherwise, it just will not work. They're also telling us that the ratios that currently are in play will be the same in the next year, the forecasted year. So asset to sales is the same, spontaneous liabilities to sales is the same, and profit margin and the payout ratio. Payout ratio is what percent of profits are paid out as dividends. Those will all be maintained. So definitions then of the variables that go into the AFN, the additional funds needed equation. Really important formula for this class, for this chapter. So make sure you've got a good handle on that. But a lot of these letters you've seen before, so I don't think this is anything that's too majorly new. S just meaning sales, and 0 is today, time 0. So most recent sales. G is growth. S1 is next year's sales. When you see the triangle, that just means delta, and delta means change. So change in sales is the increase in sales. The growth rate times S0 would be the change in sales. A0 is assets required to support sales today. L0 is spontaneous liabilities. And so A0, assets to sales, is the capital intensity ratio. How many assets do you need to support sales? L0 to S0 is the spontaneous liabilities ratio, keeping in mind that's your accounts payable, accrued liabilities. M is your profit margin, net income divided by sales. And POR is my payout ratio, dividends divided by net income. Okay, so those are the inputs. So this is slide 15. If you want to make a note of that, that'll be helpful to have in front of you when you do your homework. And so they're giving us all the data here for our company. To be able to compute the AFN equations. They went through and did all that for us. So it says the growth rate in sales for this one would be 11.1%. So here's the equation right here. I know that looks really big and ugly, but it's really not that bad. If we just kind of focus on each individual section here, it really makes sense. So remember, A0 divided by S0 is my capital intensity. How much asset do I need compared to sales to support sales? So A0 to S0 times the change in sales. So we expect sales to go up by 999,000, and so my ratio is 0.71. So that means I need to acquire just over 700 million, so 709.26 of assets to grow by the percent of 11.1. Okay, so I need to acquire 709.26 million worth of assets to grow by 11.1%. Well, some of that will be supported by the spontaneous growth in liabilities, basically my payables and my accruals. So L0 to S0 is 18% times the same change in sales of 999,000. That gets me to about 180 if I round, 179.84. So my spontaneous liabilities will increase by 179.84. That'll help offset the 709. And then I have net income. And remember that net income makes my retained earnings go up. And I can use my own retained earnings to help self-finance the additional acquisition of assets that I need to support my growth. However, we are also paying out dividends. So for us, my profit margin is 3.5%. I expect my sales next year to be 10,000. So 3.5% times 10 million, I should say 10 million would be what I think my net income will be for next year. Then 1 minus payout, the payout ratio is 0.337 of earnings will be paid out as dividends right here. Okay. And so that is my net increase to retained earnings of 218.79 million. So 709 minus the 179 minus the 218. That is my additional funds needed of 310.6 million. So basically, if this is my plan for next year, this tells me I need to come up with just over $310 million worth of financing to support the plan. And of course, that could come from debt, selling stock, any combination that I want, but I need to acquire those funds. Okay. So obviously, when you think about what affects this equation, well, the higher the growth factor, the higher the AFN. The higher the capital intensity ratio, the larger the AFN. The higher the spontaneous liabilities ratio, the lower the AFN. When basically, if we just look at all these things here in a vacuum and say nothing else is changing, just this one item, that kind of gives you a flavor for how it works. Obviously, the higher the profit margin I have, the lower the AFN will be. The more of my earnings that I keep, if I lower the payout ratio, I keep more of my earnings, which lowers the AFN. And you'll get questions like that. You'll have questions that'll pop up in your homework that'll kind of ask you, if this, then what? They'll kind of just have the formula in front of you when you get those kind of questions and say, if this one item changes in the formula, how does that affect the answer of the AFN? Okay, and then we get to the self-supporting growth rate, and basically saying, how much could we grow and not need to get additional financing? And every company should kind of have a rough idea of what its self-supporting growth rate is. And for most companies, it's typically going to be in the low single digits. And keeping in mind, if we're at full capacity. Now, obviously, if we're not at full capacity, we could grow more than the 4.3%, but I'm at full capacity, so that's the most I can grow. But if I was at 90% capacity, I can grow by more than 4.3% and not need additional financing. So this basically just says, if I kind of just grow organically, just natural growth, just due to acquiring more customers through word of mouth or whatever it be, or just, as the population grows, we gain more customers. To me, it's kind of what self-supporting or organic growth is. You just kind of just grow naturally. If you're hopefully in a city or a location as this kind of grows. And I think Sioux Falls would be a good example of that. A city that just grows organically. And, ideally that means you have more customers every year. As the city grows, you have more growth, just because the longer you've been in business and the more customers you gain, and word of mouth and loyal customers, all that hopefully leads to getting more growth. So what's the point is, what's the percent of growth that I can sustain without needing additional financing? It's taking all the same inputs and just rearranging them. So it's taking our profit margin times 1 minus the payout ratio times sales today, divided by assets minus liabilities today, minus the numerator of the profit margin times 1 minus payout ratio and the sales for today. And it gives me 4.3%. So I can grow by 4.3% and not need additional financing. Okay. So if we came up with a plan for next year and we decided that 4% should be our growth goal, maybe that's what we just think is realistic, then I don't need to do any additional financing. I should be able to self-support that through the increase of retained earnings and so on. Okay. So, but that's an important thing to remember. Alrighty, so then we'll talk a little bit about how to forecast financial statements. And remember that with all things forecasting, you generally start out with sales. You kind of go, by how much will sales go up? And then you figure that out. Then you go, okay, if sales go up, how about our costs? Will our costs go up at the same rate of sales or a lower rate than sales? How much more inventory do I need to support those sales and so on? And so you're trying to figure out, as I look at my current year and the ratios of my current year, as I grow, will those ratios change or not? And that's for me to decide. Ideally for companies as they get bigger and have more sales, ideally you have more purchasing power, and when you buy inventory, you can hopefully maybe get a better deal, right? So ideally your costs come down as sales go up. It doesn't always work out that way, obviously, but potentially. But you have to ask yourself that as you go about doing the forecasting. So that's part of what the choose a preliminary financial policy that we use to forecast the financial items. What will be kind of the financing source, long-term debt. If we have more long-term debt, that affects interest expense and so on. And so then we have to identify financing surplus or deficit and eliminate that and repeat until we believe we have the plan that works for us. So of course, with forecasting operating items first, it's all based on sales. And then many items should be based on a percent of sales. So we should hold cash at a certain percent of sales. My AR, inventory, fixed assets, and costs would all be a certain percent of sales. Okay, and of course depreciation would be a percent of fixed assets. Okay, so it means I have to really have a good handle on my current year ratios, and then decide next year, will those ratios be held constant with no change, or will they change a little bit? So I'm going to give us an easy scenario first and say that let's look at the initial operating assumptions under a no change scenario. So we're going to grow sales over the next few years by 11.1, 8, 5, and 5, and we're not going to change our ratios, and the WACC is 10%. So here's our numbers. The ratios today, 18 being our current year, and then here's our forecasted growth for the next 4 years. And then remember that we're keeping all these ratios constant. Okay, so all these ratios stay the same. Even though sales changes, we're holding those ratios to be constant. And so with that, then we can forecast pretty much every other item. And obviously you can build an Excel spreadsheet to do this for you quite easily. So sales of 19 equals sales of 18 times 1 plus the growth rate, right? Remember that growth rate for the first year was 11.1%. So my sales number in 19 will be 10 million. My inventory then is 16% of sales. So it's 1,000,006. So that's just kind of the format that you take with doing this. So if you've got a good table built like this in Excel, you can easily then use those ratios to automatically build something like this for you, because we're just holding those ratios to be true or constant and going from there. Okay, so that's a very simple approach. And the nice thing about if you do this in Excel, if you decide, well, you know what, maybe operating cost of sales will improve over the next years. Maybe it'll be 88% or 89%. And then you can kind of see the ripple effect of how that impacts this your financial statements over here, the net sales and everything else. Okay, so that's kind of how you go about that process to do that. So the next step would be, what's my future cash flows? Because obviously cash is king in finance, right? I want to know what my future cash flows are, because that helps me figure out what's my company worth. The present value of future cash flows helps me determine the worth of my company. So that's a big one for me that I want to make sure I take a look at. So I start out with my NOPAT equals my EBIT times 1 minus T. So remember that NOPAT is net operating profit after tax. EBIT is earnings before interest and tax times 1 minus T. Okay. Net operating working capital, the NOWC, is cash plus receivables plus inventories, the asset side, minus AP and accruals. Net operating working capital does not include notes payable. So we do not include short-term debt in that. It's kind of everything else besides debt. So I just want to make sure you guys kind of notice that. So total operating working capital then is my net working capital plus net fixed asset. And my free cash flow is my NOPAT minus my change in net operating capital. And then my return on invested capital, ROIC, is my NOPAT divided by total operating capital. Okay, so that's how I do the free cash flow, which they'll show us here on slide 29. And so again, I've got my years. And again, with some good Excel magic, I can just kind of make Excel do this for me, what all the numbers are, and compute these for me. Okay. Now, what's the key here is the analysis of what does this mean. My free cash flow right here in year 1 of my forecast is negative. Thankfully, it goes positive in these future years. However, my ROIC is 8.5%. And my WACC is 10. And remember that the goal is to make sure that your ROIC should be above 10, right? That should be hopefully anything above 10, we're making the company more valuable. Anything below 10, we're actually reducing the value of the company. So this is a good analysis to do. Remember, we just kind of set all these ratios in 18 as constant in the future. So now that I know if I project my growth this way, I'm really not doing myself any favors. What I should really be doing is going, what can I do operationally to change these ratios for the better, right? So it'd be a matter of identifying which ratios could we easily affect and make better. Is there something I can do to reduce operating costs? That'd be something to ask. Is there something I can do to speed up collections on my receivables? Is there something I can do to be more efficient in my inventory management and not carry as much inventory, and so on? So that's what I want to be looking at. So the purpose of doing a forecast is, if when you first do it, you don't like the numbers, you got to go back and think, what can I change? And it's not just a matter of just changing a number on a spreadsheet. It's changing real operations and coming up with new initiatives and new ways of doing things. Okay. Anyway, so now that we've got all this, it helps us calculate the new intrinsic value, which we did back in chapter 9. That was kind of the stock chapter that helped us figure that out. And it's just taking all those future cash flows and bringing them down to a common value. Remember that with this one, we have just the 1 year of 19 with the big growth. And the 20 is 8%, but then 21 and 22, it settles down to be 5%. So that's the horizon value. Okay, so anyway, so that just kind of shows us how to do that. So the horizon value, how we come up with that cash flow calculation, and so on. So that's just showing us what the intrinsic stock price is. That's the purpose of doing a forecast, though, is to figure out what's the value of my company under this forecasted scenario happening. Okay. Now, we estimate intrinsically that the value is $37.65. The actual price today is $41, a difference of 8.2%. Is this a big difference or a small difference? Well, the market expects improved performance would be one way to look at that. So keep in mind that when you do a forecast, companies do forecasted financial statements. They do all the financial statements: income statement, balance sheet, statement of equity, cash flow statement, all that. So here we're talking about we're going to grow dividends by 10%, interest rate on debt's 8%, we're not going to take on additional debt or issue common stock. Those are all things we have to establish in that preliminary financial policy. How will this look like as we go forward? And of course, we can change our mind, but we have to have some kind of a policy as we begin to build the balance sheet. Okay. So basically, then after you implement the operating plan and the preliminary financial financing policy, then we have to kind of think through how much more financing do we need, or will we have a surplus of financing? So that's what we have to kind of figure out. We have to eliminate that. So it has to go away because we have to have a balanced balance sheet. So that's what this is showing us right here. As we take the 2019 numbers on the income statement and we use that to build a forecast that helps us kind of figure out what the future income statement will look like based on all this. So we take the 19 numbers, plug in the various percentages to get the new 2020 income statement. You can see right there. And that helps us build the balance sheet. So you can see here what my balance sheet looks like. I've got my inputs, my forecast, and that builds me my new balance sheet. However, it doesn't balance initially, which is not unusual. So assets are $7,100,000. Liability and equity is $6,802,000, a difference of $298,000. So that's when we have to go back and fix and decide how should we fix that. So you can see here how we do that. We'll have an increase in spontaneous liabilities of $180,000. We're not going to issue long-term debt or sell stock. We're not going to do anything with a line of credit. We will have some net income though of $232,000. So the increase in financing is $412,000 minus the increase in total assets of $710,000, and so my deficit's $298,000. And so I have to decide then, if that's a negative, I draw on a line of credit. So current debt is what I would use. If it's positive, I could pay a special dividend to make that go to zero. So the key is I have to force that to go to zero just based on the rules of logic that I want to apply. So we go ahead and we do that. We draw on a line of credit, this $298 right here, because we decided we would not issue long-term debt and we would not issue more sales of stock. So the only option left over is just to say that's just short-term debt, like a line of credit that we'll draw on to cover the difference. So we'll borrow $298 million on a line of credit, and then we balance. Okay, so that's kind of just how the process you have to go through to do that. Oops, didn't mean to go too far there. Okay, so this is kind of that circle you have to go through as you do that. It's just kind of what we call the financing feedback or the financing loop. And obviously every time you adjust your numbers or change them, you have to go through and verify, does my balance sheet balance? Okay. And you can do that manually. You can 100% build an Excel formula right here where this 298 is to automatically make that work for you. I mean, that's really easy to do. So that that's what most companies would do, is we would just put in this plug line and call it short-term debt or line of credit, and that would be my plug to always make it balance. But I can always just look at that cell and go, does that number make sense based on everything else? So I used to do this kind of work, and that's exactly what we did. Okay, and then obviously now if I don't want to draw on a line of credit, what else could I do? Well, if I reduce dividends, my need for a draw goes down, or I could issue long-term debt or issue common stock. I could decide to not grow as much, which would reduce my need for financing. I could improve my operations, which for this company should be a major goal, improve our operations, basically cut down our costs, I think would be a big one, and so on. So it's what they call an iterative process. I mean, I can tell you that when I used to do this kind of work, we'd go through well over 100 iterations of something. The very first one was just a starting point, and then you just made various adjustments and tweaks and trying to figure out what's realistic, what could happen, and then coming up with it. So you just go through several iterations of it before you get to it. And of course, what this company should be doing is planning for improvements. Reduce operating costs, reduce inventory, be more efficient with the use of our fixed assets. If they could pull off any just one of these things, their need for additional financing will go down and the ROIC will go up, which for them is a big deal. They want that ROIC to be above the WACC. So this company should be looking at this initial forecast going, okay, now we see the need to improve operations here. This is the giant red flag that says we better make things better. And that's kind of just what they're showing us here at these next few slides. Okay, just kind of how the new numbers will pan out if I go ahead and do that. And just kind of show the results of my new numbers, and that I'll need less financing, and so on. So that's just kind of what they're showing us with all those. And of course, if I have a surplus, I could pay a special dividend, or I could buy stock back. I could pay debt off. I can just take that extra cash and buy marketable securities. I don't have to pay a special dividend. So when you have a surplus, you have options. When you have a deficit, you have options. It's just really a matter of what the company is trying to accomplish and what their long-term objectives are as to deciding which one we go with. Okay, hope that all made sense. It's a good chapter to finish up with. And forecasting is a big deal. The additional funds needed formula is a big deal. So hopefully it made sense for you. Thanks.